Good afternoon, everyone. Thanks for joining us for this webinar update with Seb Bilo and Claire Jervis from Web Asset Management. Web are the portfolio managers for the Pengana Web Sustainable Impact Fund. I'm Adam Myers, I work for Pengana and I'm the local investment specialist for the fund. This afternoon, Seb will take us through the highlights of the 2021 Impact Report, and then Claire will provide an update on the investment strategy for the previous quarter. Their presentation will hopefully take less than 30 minutes, leaving time for questions at the end. Please enter your questions in the question box, which can be accessed from the icon on your screen. Seb, over to you.
I'm Seb Bilo. I'm the head of research at Web Asset Management. And I'm going to be introducing our impact report today. We published this at the end of June. And then, as Adam says, I'll hand over to Claire, who will take you through a review of fund performance from the second quarter. So just turning to the impact report, we decided this year to go with a cover of a wildfire this year, which reflects really the extreme urgency that we now feel about the need to tackle climate change. You may have heard that last week temperatures in the UK were higher than they have ever been in recorded history. And we had our own wildfires in this country, which is something which is still quite unusual. Obviously, that's different for you in Australia, where you've had quite a lot of experience with wildfires. And this prediction of extreme weather really is something that we hardly need to do every year now, because it's almost a given that we'll be breaking records of one sort or another. The IPCC, the Intergovernmental Panel on Climate Change, actually published a report in April this year that was billed in effect as their final warning that the time is indeed now to commit to the wholesale change that we need to see in the global economy if we are to transition to a net zero carbon and more sustainable economy with a safe, stable climate and biosphere that we depend upon. So in terms of some of the key highlights from the impact report, this idea of change is something that we think is central to impact investing, and it's something that we highlight in the report. The idea of impact investing really is to deliver an investment return, of course, but also to help deliver change. And companies that we invest in take inputs in the form of capital and labor and so on, conduct their activities and generate outputs in the form of products and services. And these products and services have positive impacts that ultimately lead to positive outcomes on key social and environmental issues. And our report sets out this theory of change and the related problem statements that our investments are trying to address for the strategy as a whole and for each of the investment themes. So, for example, at the level of the strategy as a whole, our theory of change is that the global economy currently consumes resources at a rate that is unsustainable. Web's investment strategy invests in companies that sell products and services that provide solutions to these challenges and that protect and enhance the quality of life. So that's the strategy, the theory of change for the strategy as a whole, which is necessarily quite high level, given that we have 9 different investment themes. But we have a much clearer articulation of the key problems that we're trying to solve at the level of each investment theme. So, for example, for our resource efficiency theme, the problem statement is that in order to meet a target of net zero carbon emissions by 2050 and keep global warming to less than 1.5 degrees centigrade, the global economy needs to increase energy efficiency by more than 4% per annum from 2020 to 2030. So that's the problem statement. And we then have 3 different areas that we focus on in the investment theme, where we've developed a theory of change for each of those companies, detailing how their products and services address this problem. So, for example, A.O. Smith in our more efficient buildings sub-theme sells water heating equipment, including efficient electric boilers and heat pumps that go into buildings. ANSYS sells software tools that enable more efficient product design and development, and Power Integrations sell semiconductor chips that enable much more efficient electrical equipment, particularly in homes and residences. So you can see how each of those 3 businesses, the products and services that they sell, directly help to address that problem statement. And we have a similar approach for all of our other themes, and indeed for every single investment that we make. And those are detailed in the impact report. And this is what makes our impact calculator relatively straightforward to calculate, because each investment is connected with a particular theme, and in the majority of cases is linked with a specific performance indicator, whether that's renewable energy generated or numbers of people receiving healthcare. And over the 6 years that we've put together the impact data, we've gone from around 40% of the portfolio reporting data to nearly 60% this year. Interestingly though, the proportion that don't report has stayed pretty static at around 20%, and the other 20% last year was estimated. So we calculate impact data using enterprise value, including cash, as the denominator, which is a slight change from last year. But more importantly, we now report data based on the holdings in the portfolio throughout the year. Until this year, the impact was associated with the holdings in the strategy at the end of the year. This year, we've done a calculation that includes prorated contributions from companies that we sold during the year. So for example, if we held a company from January until June and then sold it in June, previously we wouldn't have included it. This year, we have included the 6 months contribution to the impact. And like last year, all our data has been scrutinized by the Carbon Trust and found to be robust for the purposes of the impact calculator. The other thing that we've done this year is that we've been conscious for some time that while the main impact of the products and services that are produced by portfolio companies is positive, they sometimes also have some negative impacts. So for example, we invest in businesses that make COVID tests, and I think we can all agree that they've been pretty essential, sadly, for the last 2 years in terms of keeping people healthy, or at least letting you know when you've got COVID. But they've created a lot of additional plastic waste as a negative impact associated with that. Companies typically don't report these negative impacts, and so they are very difficult to quantify, apart from carbon, which I'll come back to. But we do provide some disclosures in the report as to what we think the principal negative impacts are. So just turning to carbon, we report a pretty comprehensive data set for the carbon characteristics of the portfolio. And in fact, increasingly, this is a sort of standardized set of metrics that you need to report if you're a member of the Net Zero Asset Managers Initiative, which we are. And there are basically three stories here, which I want to highlight for you. The first is on the left-hand side, the metrics basically cover the scope 1 and 2 emissions of the portfolio. So the carbon emissions that are associated with the operations of the businesses that we invest in. And you can see that we've seen a really quite dramatic decline in carbon emissions from 2020 to 2021. And there are two principal reasons for that. The first is that we sold a company called China Everbright Environment Group, which is a waste to energy operator in China. We sold it for several reasons. Two of which were, the first was that we've concluded that energy from waste is no longer really a solution to an environmental problem. Previously, we considered that particularly in emerging economies where waste management infrastructure was still a bit immature, we considered waste to energy a preferable way of managing waste than landfill, let alone just dumping it in the environment. However, waste infrastructure has improved now in most of these countries, and we don't think burning waste, even if you get the energy back from it, is really a sustainable solution. Really, you should be recycling it. So that was one reason we sold. Another reason was because we had asked them to set a net zero carbon target, and they'd been quite resistant to doing that. And we've always reserved the right to divest from businesses who haven't taken these issues as seriously as we think they should. So that was another reason that we sold. And that was behind a large part of the decline from 2020 to 21. The other reason, just very quickly, is because actually the rest of the portfolio has got better. Their carbon intensity metrics in particular, so the carbon emitted per unit of revenue, for example, has improved, which of course is really important because that's where we need to get the reductions from, really. It's not really good enough just to sell companies. We need to see reductions in the companies that are in the portfolio. And then on the right-hand side, just a couple of points here. The first is that our scope 3 emissions, which are relatively high and remain high, the reason for that is because we tend to invest in businesses where the products are using energy or electricity, like the example I gave earlier on with A.O. Smith. Although their equipment is more efficient than other competitors in the market, they have more energy efficient water heaters, they still use a lot of electricity, just less than the competing technology uses. So they still have a significant scope 3 carbon footprint. And then the final story in this data, which we're also really pleased about, is just underneath that in terms of the net zero carbon commitments. We have a policy of getting all of our portfolio to commit to being net zero carbon by 2050 at the latest, and the deadline for that is 2030. We also had a target for 2025 to get to 50% of the portfolio having set that a target, and we were at 44% at the end of last year, up from just 2% just 2 years beforehand. At the end of June, we just went through 50%, so about 53% of the portfolio have now set a net zero carbon commitment by 2050 at the latest. So we're really pleased to have been able to hit that target 2.5 years before, 2.5 years earlier than we'd expected to. So that's the sort of carbon, the key messages from the carbon analysis of the portfolio. We also do a lot of engagement work. This is something that's very important to us, and we believe it's very important to our investors as well. We engaged with on 156 occasions in 2021 with 41 companies, which represents nearly 80% of the portfolio. And these aren't just, firing off a letter. These are deep engagements that often involve multiple interactions with the company. And you can see on the right-hand side, we also assess the effectiveness of that engagement. And you can see that the long-term story here, this is data going back to 2014, the long-term story is pretty good. We've significantly increased the proportion of our engagement that we consider to be either partially or completely successful. And the proportion that's unsuccessful has declined pretty dramatically over that period. We have seen a bit of a tick down in the proportion of successful engagements in 2021. And we think the main reason for that is because we are now asking more difficult things from companies. In the past, there were some relatively easy wins around getting them to produce a sustainability report or develop a sustainability policy. Now we're asking them to change their performance, to reduce their carbon emissions or to improve gender diversity or whatever it is. And those things take time. And we think that's partly why we're seeing this increase in unsuccessful engagements. And then finally on this chart, the other thing that we're very conscious of is it's very difficult to claim responsibility for any of those changes, to attribute the change to us, to our interaction with the company. We think that that's too simplistic. Companies change their policies for all sorts of reasons, but we hope that Web is driving them in the right direction. And we do have quotes from companies saying that Web has been a big part of their journey. We had a quote from Intertek last year, the UK company. This year we have a quote from Smurfit Kappa, which has been in the portfolio for many years. They're a recycled cardboard manufacturer. So finally, before I hand over to Claire, I did want to just leave you with leave you on a positive note, which isn't so easy perhaps at the moment with a lot of difficult times this year. Some of you may remember that we gave a rather gloomy outlook at the end of last year, where we were talking about Russia's belligerent posturing towards Ukraine. This was still before they invaded, the return of inflation, the likelihood of extreme weather, the continuing fallout from the COVID pandemic, lots of fairly gloomy narratives. And at the time we felt that was pretty gloomy, but it turns out that actually we perhaps weren't gloomy enough in terms of what we thought would happen. And this is particularly true with regard to climate change, I think, where it's been a particularly tough period, concluding most recently with the end of President Biden's ambitions to pass comprehensive legislation on climate through the US Senate. I am conscious, of course, that we have a much more progressive administration in Australia, which is good news. But the wider backdrop hasn't been great, I would say. But it is our experience over the decades that we've spent analysing capital markets that the media headlines often miss underlying tectonic shifts in industry. And one of these shifts was revealed in BP's latest Energy Outlook report. All three of BP's scenarios now model at most a peaking of carbon emissions. And actually the underlying data shows that total fossil fuel demand in 2021 was less than it was in 2019. And that all of the increase in energy supply since 2019 has come from non-fossil sources. Solar and wind are now 5% of primary energy supply and are growing at about 20% per year. And total energy demand growth is about 1%. So solar and wind are now accounting for all of this growth. And it is in fact highly possible, if not in fact probable, that carbon emissions from energy use and industrial processes globally actually peaked in 2019. And if it didn't, we are at or very near that peak. The key question now is how quickly we can get emissions to decline. But still, on that, what I think is rather a positive note, I'll now hand over to Claire, who will walk you through the performance of the strategy over the last quarter. So I'll now stop my sharing, Claire, and hand over to you.
Thanks, Seb, and hi everyone. For those that don't know me, my name is Claire. I'm an investment analyst with Webb's Sustainable Impact team. I'm just going to share my screen just quickly. Okay, so I'm here to give you just a brief update of how our strategy performed in the second quarter of this year. Just starting off by looking at a bit about the macro backdrop. So obviously, the main headline that's been in the news for the last few quarters really is the rapid rise in inflation from rock bottom rates at the beginning of 2020 all the way up to high single digits, which is what we're living through right now. But the positive news I want you to take from this screen is that we expect that peak inflation has now passed now. So the green line here shows the probability of inflation being above 3% in 5 years' time. And as you can see, that has come down rapidly over the last few months, suggesting that hopefully we are through the worst of the inflation. And a big driver of that really is what you're seeing on this slide here, which say projected slowdown in global economic growth. So this is data from the World Bank, and you can see that even as early as January this year, the World Bank was projecting a slowdown in economic growth, mainly driven by things like supply chain disruptions, ongoing lockdowns in China. But because of the Russia and Ukraine war, that has now led economic growth projections to come down even further. Russia and Ukraine is now in economic decline. Some advanced economies may now already be in recession. And so this is actually taking some of the burden off of demand and helping to alleviate inflation. And one thing that's linked to that is the expectation for an industrial recession, because when there's a slowdown in economic growth, it also comes with a slowdown in industrial demand, which you're seeing here in the Purchasing Managers Index, which is a forward-looking leading indicator for industrial demand. And this is actually really relevant for our strategy because we do tend to have an overweight to the industrial sector, simply because we do find a lot of opportunities in companies whose products and services limit greenhouse gas emissions, help with energy efficiency, as Seb was mentioning, within the industrial space. So that has been a headwind for us. And moving on to more environmental news flow. So you may remember I was here last quarter giving you an update on how we thought the Russia-Ukraine war was going to impact renewable energy policy and demand. Well, this slide really gives you the flip side of that, which is the regrettable backsliding of a lot of countries in response to the severe energy shock that we've been living through over the last couple of quarters. So you've got here a list of countries who are either expanding their domestic fossil fuel production, signing new or expanding existing fossil fuel contracts, or even purchasing discounted Russian oil and gas. So that is obviously very unfortunate, but we are optimistic that this is simply a short-term reaction to what has been an extreme energy shock, and that the long-term strategic imperative to transition to renewable energy remains in place. And as Seb was mentioning earlier, that is something, we've seen renewable energy take an expanding share of energy supply. So that's something we expect to continue. And of course, that's very important for our strategy because we do have a cleaner energy theme. We're invested in companies like Vestas Wind Systems and First Solar, which are equipped to provide the infrastructure that we need to proliferate renewable energy. And another thing that's been in the spotlight this quarter is energy efficiency. So the International Energy Agency had its 7th global conference on energy efficiency, and that highlighted the data that you're seeing on this chart here. So on the left-hand side, what you can see is the annual reductions in energy intensity, which we've achieved on a global basis, going all the way back to the year 2000. And as you can see, we've historically struggled to break through that 2% annual reduction in energy intensity. And that's way too low, because the IEA is actually saying that we need to achieve a 4% annual reduction in energy intensity for us to meet our net zero carbon goals. And in fact, Seb tells me that the only country to have ever achieved a 4% annual reduction is Norway. So the rest of us are really lagging. And this is, as Seb was mentioning earlier, a key focus for our investment strategy. And we have a number of companies which we believe are well equipped to help drive improvements in energy efficiency through their products and services. And that brings me on to our Q2 performance. So as you can see from this slide, we have unfortunately seen a continuation of underperformance relative to the MSCI World, which is the global index that we measure our performance against. And really the main driver of that has been a continued lack of favour towards companies that might be considered growth, whereby companies in the kind of value space, especially fossil fuel energy and financials, have been more resilient. And of course, because of the nature of our strategy, we look for sustainable equities, we are very growth oriented, we simply don't have exposure to fossil fuels and financials. So that has been a headwind for us. And this slide just gives you some insight into the thematic drivers of our performance during the second quarter. And the main thing I'd want to draw your attention to here is that thematic selection effect at the top. Now, this is something that we use to measure our headwind or tailwind from focusing on sustainability. So what you're seeing here is a positive thematic selection effect. And what that's actually capturing is the fact that we don't own a lot of those big tech companies like Apple, Amazon, Alphabet that have really struggled over the last quarter. And over the next few slides, I'll just give you some context into some of these themes like resource efficiency, well-being, and on the positive side, education. Starting off with resource efficiency. So two of our weaker names in the quarter were Kion and Daifuku, and these companies provide solutions to warehouse and logistics automation. And we believe the reason these companies have been relatively weak is because they are seen as being very well correlated to e-commerce penetration. So as you can see on the left, e-commerce really boomed through COVID-19 as we were all stuck at home, ordering things online. But that has now started to tail off over the last couple of quarters. And we believe a lot of investors are, in our opinion, naively extrapolating that to mean that e-commerce is going to struggle for the next few quarters or even few years. We actually see this as the wrong lens through which to look at Kion and Daifuku. The reason for that is that we speak to companies all the time in the industrial space who have warehouses and factories. And what they're saying to us is that their biggest worry is labor inflation. Wages going up, simply not being able to get the staff. And also resource expenses as well. Their cost inputs are going up as well. And Kion and Daifuku are both really well equipped to help those companies reduce the burden of labor, but also manage their resources more effectively and ultimately help to lower their cost base. So we think the outlook for Kion and Daifuku is very strong, and that is coming through in their order growth, which you can see on the right-hand side. Another company in the resource efficiency which has been relatively weak is Infineon. Infineon is the leading global provider of power semiconductors. And as you can see, it gets almost half of its sales from the automotive sector. And that sector has been struggling over the last few quarters because it simply can't get the critical components it needs to make the cars, basically. And there's also a fear that a potential slowdown in consumer confidence is going to lower demand for light vehicles especially. So that has been, in the short term, a headwind for Infineon. However, we are long-term investors, and the reason we like Infineon is because of its auto exposure. The image you can see on the right-hand side is a cross-section of an electric vehicle, and Infineon has components which go into all of these parts. So the onboard charger, the battery management system, the inverter, and in fact, about 50% of all electric vehicles hitting the market in the next couple of years have some sort of Infineon equipment on board. So over the long term, we think that Infineon is really well set up to benefit from the transition to electric vehicles. And just as a counterpoint to that, one of our strongest performing companies this quarter was actually another semiconductor name, which is Silicon Labs. Silicon Labs is exposed mainly to the Internet of Things, connectivity, and smart home space. And that company has seen continued strong revenue growth, as well as a rebound in its operating margin, which was much better than a lot of investors anticipated. So that company has been well rewarded this quarter. And our second weakest theme in the quarter was well-being. And that was really wrapped up in HelloFresh, which, as many of you all know, is the leading provider of online meal kits. And the reason HelloFresh has been quite weak is because of this chart on the left-hand side, which shows not only a reduction in consumer confidence, but in fact, the consumer confidence index is currently at the lowest point that it's ever been in all of its history, which dates back like 20 or 30 years. So we're really in a severe consumer crisis right now. And a lot of people are looking at that and thinking, well, you know, is demand for HelloFresh's meal kits going to stay? And we're pleased to say that actually on the numbers, HelloFresh has been relatively resilient. Its first 2 quarters of this year actually met or beat its guidance. And although it has started to see a little bit of churn in its customer growth, it's very low. It's only about mid-single digits, which is a lot more resilient than even a number of online delivery companies, which a lot of people view as its peers. So we're still comfortable with HelloFresh, we still have a position, and we still think that we should have long-term conviction in the company's long-term guidance. And finally, on the positive side, our best performing theme in the quarter was education. And that is due to Grand Canyon Education, which is linked to a university in Phoenix, Arizona, which of course has been struggling to get student enrollments during the lockdown period, as you can see on the left. But positively, management has been guiding for a very strong fall 2022 student intake. They say the registrations are there, they're getting good inbound inquiries for on-campus residencies. And so we're optimistic that this period of a contraction in student enrollments is now behind us, and that we can see a more positive outlook for Grand Canyon Education going forward. And with that, I'll hand back to Adam for Q&A.
The first question is actually quite a fundamental question. Please, can you explain, probably better for Seb, what the distinction is between scope 1, 2, and 3 emissions?
Yeah, scope 1 is basically where you're burning fossil fuels yourself and producing carbon emissions through the burning of fossil fuels. Scope 2 is where you're consuming electricity, which is associated with the burning of fossil fuels, but you're not burning the fossil fuels yourself, you're just using electricity. And scope 3 is really kind of everything else. Actually, it's, you know, all the upstream emissions associated with the components that you might buy from suppliers, and it's also all the downstream emissions as well, including the impact of the use of a product and the emissions associated with the use of the product, which is why our scope 3 emissions are quite high. People do actually, just if that's not complicated enough, people do actually now talk about something called scope 4, which is the avoided emissions. So if you consume renewable electricity rather than grid electricity, then you avoid a certain level of emissions, and sometimes that's called scope 4. So I hope that's helped to clarify that.
That was comprehensive. And so feeding on from that, it's great that a large portion of the portfolio has now committed to achieving net zero emissions, but how concrete are their plans for getting there?
Yeah, so that's a very good question. And when we engage with our businesses, we ask them to set a net zero carbon target by 2050 at the latest. We prefer them to do it by 2030 if they can, but by 2050 at the latest. We do also encourage them to have those targets validated by a third party, and the sort of the main show in town is something called the Sciencebased Targets Initiative, which is an independent body that was WWF and other NGOs were involved in it, set up CDP as well, and they will validate corporate commitments to make sure that they're consistent with the science. So it's quite important that companies do have them validated. We do also look at the strategies ourselves to work out whether we think they are robust. But yeah, there are quite a lot of commitments that aren't robust. In our portfolio, 46% of the portfolio targets have either been validated or they plan to have them validated by the Science-Based Targets Initiative. So that's definitely something that we look at as well.
Great, thank you. Claire, next question, I think for you. You spoke about a reduction in energy intensity. What does that actually mean?
So energy intensity is basically, I guess, unit of energy per unit of outcome, I suppose is the easiest way to think about it. So it's how much energy you're using. So say, for example, if you take a dishwasher, say a dishwasher uses, I have no idea what the number is, let's say 100 kilowatts of energy, just to be easy. So if you can get the same output from that appliance, but with 80 or something, then that's going to be a reduction in energy intensity. So that is what we need to achieve, basically unilaterally across all of our electric appliances. Some countries are better than others. America is notoriously the worst. Some of their appliances, and Canada as well, use a lot more energy than other parts of the world. And one challenge there is that the consumers are used to it. They're used to being able to, throw their sheets and duvet covers into the washing machine and tumble dryer, have it all cleaned and dry in 30 minutes, which is too much. There is an element of changing consumer expectations. Policy may have to help with that. But there is, of course, an investment opportunity there as well. So one company that we're invested in, which I'm personally very excited about, is Power Integrations. They make energy efficient semiconductors, which means that what they're actually doing is they're giving the appliance essentially a brain, so that when you are putting that appliance into standby and not using it, which a lot of people do, they don't switch it off at the wall, they just leave it in standby. That appliance knows, okay, I'm not being used right now, and it drops its energy right the way down to close to zero. And so without any change to consumer behavior, that appliance can use a lot less energy. So that's something that we're really excited about. And it is being, their semiconductors are making their way into all sorts of appliances, consumer electronics, and even cars as well. So that's really exciting for us.
So sounds like impressive technology. Next question also for you, Claire. What are the risks to the HelloFresh thesis?
Yeah, it's a great question. So HelloFresh, I think the main risk really is that they have been expanding their capacity to meet the demand. And of course, they had such strong demand during the COVID pandemic that they had really no choice but to accelerate their capacity investments in order to continue to grow. And of course, that's come at a time where we've gone into this kind of consumer slowdown, potentially. And that's, I think, what a lot of people are seeing. It's not only the risk on the consumer side, it's the fact that they're building this capacity and there's kind of a fear, will they be able to fill that capacity? We, of course, are very aware of that fear and that risk. But as I've mentioned, we continue to look at the numbers coming out of HelloFresh, and we continue to see them as being relatively resilient. The quarter to come, they've just announced kind of 6% kind of decline in users, which might seem, I don't know how you think of that, might seem high, might seem low. To us, it seems relatively low. And then we have a company called Deliveroo, which is a UK listed company, also an online consumer food delivery company. And they've cut their guidance for this year by something like 50%. So on a relative basis, HelloFresh is looking pretty resilient. And actually, we think that, although a lot of people may consider their product to be consumer discretionary, they have a core user base of users who have this as their kind of weekly or bi-weekly food shop. And they've been really resilient and haven't been giving, their behavior has changed so that this is an integral part of their lifestyle now. So, the risks are certainly there, but we continue to watch the numbers very closely. We're looking at them relative to peers in the kind of consumer lifestyle space. And we think that actually they're a lot more resilient than the market's giving them credit for. And in fact, at the valuation that it is now, they don't even need to meet their guidance to be good value. We think that they will meet their guidance for 2025, but really they can achieve something much, much lower and still be good value. So we're happy with the position.
Great. Second to last question. When you were talking about Infineon, you spoke about being long-term investors. Maybe on a philosophical basis, say this is one more for you, but why is a long-term lens so important for impact investors?
Yeah, I think it's part of what it means to be an impact investor, to be long-term. I mean, we think by its nature, really, a lot of these changes are long-term, happening over many years, if not many decades. And so if you're kind of investing in them, then you really have to kind of adopt that kind of time frame. But we'd also argue that one of the characteristics of impact investing is that you're supporting the companies. You're investing in them to support their activity and to increase their positive impact. And in order to do that, you have to be a kind of reliable, supportive shareholder. And if you're constantly, cutting and reinvesting, you're not really being a supportive shareholder. You're just trading around the value. So we think it's kind of inherent in being an impact investor that you have to have a long-term perspective.
Great. And then one last question from an investor who obviously knows the fund pretty well. But basically, the question is that the advances in the impact reporting seem more incremental this year than in previous years. So you guys have always led the pack in your impact measurement and reporting. Is this an indication that we are reaching some kind of a plateau? And if we aren't, what are the areas of likely innovation that we should expect going forward?
Okay. I don't know if that's a comment on our report. Certainly it feels like we try very hard to try and sort of push the boundary every year. So I'm sorry if it feels a bit incremental. It didn't feel incremental when we were doing it. But I think probably in terms of the data, I suppose, is it plateauing? I mean, interestingly, I gave you the stats earlier on. We've gone from over the course of the last 6 years, we've gone from 40% of companies reporting data to 60%. So I would say that's quite a good improvement. But interestingly, 20%, there's this core of 20% of companies that just aren't reporting data. So clearly we need to try and get that to change and get those businesses to start reporting impact data. I think there is regulation that will help. Certainly the taxonomy, I don't know if you're familiar with the EU taxonomy in Australia, but it's some legislation that the EU have passed, which will really encourage companies to start reporting product impact. So that should be very helpful for us if companies start doing that. So I think maybe it is becoming more incremental. Maybe that's also where we are. We've seen the kind of initial flurry of excitement around impact investing, and now we're into a bit more of the kind of hard graft of just kind of driving performance, but it's going to be slower progress from here. But we'll certainly up for that, and we'll be pushing as hard as we can to get companies to embrace this.
I have no doubt of that at all. We have no more questions, so I'm going to wrap it up. Thank you very much to everybody for joining us this afternoon, and for Seb and Claire for joining us this morning, bright and early from the UK. I guess my key takeaway from this report is the enormous progress that's been made on the carbon emissions related metrics. I just want to remind everyone that this isn't a portfolio of banks and software businesses. The environmental themes are full of industrial companies, and industrial companies tend to have higher carbon footprints. And this is to some extent reflected in the higher scope 3 emissions. But importantly, the companies that we're investing in are interacting with the environment in more and more efficient ways. So that to me is real progress. If you have any other questions, please get in touch with us. We'd love to hear from you. And thanks very much. Have a good evening.